Good morning, everybody. Good afternoon and good evening for those on the East Coast and around the world that are listening in. I've got one job to do here this morning, and that is to draw a firm, solid line between the past and the future. Because for the 3.5 years that I've been at Lumen, there's been this dark cloud about the finances of the company, the balance sheet. The balance sheet was the only conversation, and we're putting that to bed today. But before we do that, I want to take a step back, and I want to talk about why. And I want to talk about why that conversation still exists today. And it exists today because it's the playbook for enterprise telecom, except for right here. So, if you look at what happened, if you go back to the 90s and early 2000s, literally billions of dollars were deployed to build new fiber networks. Supply eventually outstripped demand, and the industry was plagued by a lack of scalability, right? Everybody had these fixed assets. There wasn't a lot you could do with it. So what did that do? It put price pressure. It was commoditized. So people started selling on price. Oh, well, that's not too good. But the network was still inflexible and static, and it wasn't evolving for the changes that were taking place around it. I mean, just pause for a second. Does anyone in this room think that the network today is what a network engineer would design to support an AI multi-cloud world? I don't think so. We got here by accident, and we got here because of this. So, revenue started to fall as prices fell, margins fell, companies started to consolidate. That's the answer. I know, we'll go buy each other. We'll get that next layer of efficiency. We'll scale that way. We'll outrun price deflation by consolidating. Except that didn't work. And so, what happened? All right, we got a lot of cash, but we're not going to invest it because this thing is moving down and to the right. We're not going to innovate anymore. And, you know, the innovation was stifled. So the cycle just kept repeating itself, right? How many of these companies had dividends, still have dividends today? They are a prisoner to the dividend. Oh, wait a minute, we got to pay the dividend again. I know what to do. Let's go raise debt. Money's cheap. Let's do that. Leverage rose, right? It just continues. It's a terrible, terrible cycle. And that is why enterprise telecom has a bad rap. But that is not the rule book that we're playing by anymore. Now, I'm going to talk about this in more concrete terms and using Lumen as an example. But before I do, I'm a car guy. And my childhood idol was Ayrton Senna. And this is a quote that I shared with the Lumen management team when we kicked off Dare to Lead in February of 23. And the quote's pretty simple, right? You can't overtake 15 cars in sunny weather, but you can when it's raining. It was raining. All right? 20 billion in debt, almost half of it due in 1 year. Time was running out. This quickly became affectionately known as the middle finger chart. All right? That's what we were up against. It was staring us right in the face. And analysts, investor analysts, some of you were writing our obituary. So time was of the essence. It was existential. The crazy thing, though, that is not represented on this chart, if you look at the management team that Kate shared with you earlier, outside of Kate and myself, everybody showed up after this. They ran into the fire. And they ran into the fire because they saw the tremendous opportunity that this company had and the assets that it had and the ability to transform telecom. So from there, we got into a bit of a situation with our creditors. And the creditors were concerned. And that was in the news, and that was the cloud that was hanging over our heads. And this is where we were starting kind of at the end of 23. The deal wasn't done yet. A lot of debt outstanding, 20 billion in debt, leverage above 4 times, 1.2 billion in interest expense. And then we did a thing. We did the largest out-of-court debt restructuring in history, and what that allowed us to do is it bought us time. It bought us time, it pushed maturities out. We still had a lot of debt. Leverage rose because EBITDA is still declining, and really importantly, we had to pay a lot to get that flexibility. $1.4 billion a year in interest expense. December of 23, not yet 2 years ago. And then we renegotiated the debt. And with the renegotiation, we knew we had an opportunity with PCF. And that's why we did it. I cannot tell you how many times Kate and I got asked the question, why didn't you just file Chapter 11? Why don't you just do what everybody else does in telecom? Consolidate with somebody else, write it all off, and start the clock again. Again, the old playbook, right? Drive scale through consolidation. We said, no, there's a better way. There's assets here that have value, and we're going to monetize them. What happened? Within 6 months, really within 3 months of signing that deal, we signed our first $5 billion. And within 6 months, it was 8.5. And that allowed us to start to chip away at the debt and to refinance things and to start to get to a more normal maturity curve. Leverage is still increasing because we're chasing the declining EBITDA. Interest expense is starting to come down. And if you play the clock forward, with the sale of the consumer fiber to the home business, we significantly delever. We go from over $18 billion in debt to 13, our leverage falls below 4, and roughly 2 years after negotiating the largest out-of-court debt restructuring in history, we're cutting our interest expense in half. So this isn't about Lumen's balance sheet anymore. This isn't about playing by the old rules. This is about where we're going, and everybody else can keep playing the game the old way. That's giving us a huge advantage today, and we're going to take it. So we have financial freedom. We're on a path to return to business segment revenue growth in 28. Kate talked about that. Total Lumen in 29. We see EBITDA stabilizing next year and inflecting and starting to grow. We're investing what we need to. And we're going to get into that in great detail today. We're focused on execution, and the word I love the most on this chart, optionality. There's lots of things we can do. And by the way, we're not going to get it all right every day. One of the biggest attributes of this company is its ability to adapt, to be nimble, to adjust to trends and realize where we've messed up and pivot. We have optionality now. We've got a balance sheet that actually works in our favor. We can invest in our future. We can continue to delever. And at the right time, if there's an asset that we can acquire that would further that strategy, we can do that too. And if none of that's available, guess what we can do? We can buy back stock. Those words haven't been spoken inside of Lumen in years. Now, what we're doing isn't anything new. Kate talked about that. This is connectivity, it's security, it's Ethernet, IP waves, and VPN, but we're selling it differently. It's Ethernet on demand. It's VPN on demand. It's a different way and a more flexible way for customers to upgrade their networks and meet their needs in an AI multi-cloud world. Now, I'm going to repeat some of the slides that Kate showed, but if you look at the strategy, I do want to get into these in a little more of a financial view. The physical layer, it's so important. I'm going to share a slide with you in a second because that is our enduring competitive advantage. No one else has what we have. And that's why no one else participated in that $9 billion so far. I don't know of anybody that wouldn't want $9 billion. They didn't because they couldn't. We can. Kai's going to talk about our unparalleled network expansion. Dave's going to talk about the dramatic, and I mean dramatic, reduction in cost that we can bring customers, which gives us pricing power. Ashley's going to talk about the connected ecosystem and our key to market growth as we go forward by leveraging technology companies who need our network to make their products better. And Anna's going to talk about how the culture ties all that together. It's the foundation of everything we do. We're customer number one. We're doing this to ourselves before we take our products to anybody else, and we're learning as we go. Now, we've shown this slide a number of times in earnings. This is what's important. These assets, Kate talked about no more Field of Dreams builds. What gave us this opportunity was a Field of Dream build. And it happened 26 years ago when Level 3 put conduit in the ground all over the US. And at the time they put that in the ground, they thought they would get, maybe a dozen strands of fiber through each of those conduit. Kai's going to talk about the fiber count that we can pull through today. It's dramatically higher. So this is immensely scalable. We can rip and replace. We can take advantage of empty conduit, which is what we did with the hyperscalers. And we still have lots of capacity left. We're basically quadrupling our inner city miles, and we still have enormous capacity left. No one else has this. You want to level the playing field in the enterprise landscape, and you're a competitor to Lumen's, you better start now. It's going to take you years, and it's going to take tens of billions of dollars to level the playing field. Now, what all this means, and Kate touched on this earlier, is as we move through this, you're going to see a lot of things start to change in our financial situation. The digital and the ecosystem layers really provide scalability. That fabric port, can't say much more than that because, again, I don't want to steal Dave's thunder. That changes everything. It's not one set of infrastructure for one service. It's one set of infrastructure for infinite services. That's scalability. Oh, wait a minute. The only way you can scale enterprise telecom is by consolidating? Wrong. With that, we see a path to revenue growth. We see margins expanding in the range of about 20%, so get us into the mid-30s as we go forward. Free cash flow we talked about, we've addressed that, and we address it further with the sale of the consumer fiber to the home business, freeing up $1 billion a year in CapEx. And capital intensity will fall. We think that once the PCF builds have completed, and by the way, that's not really a fair comparison because we get paid up front for those builds. It's not really cash that we're financing. But even if you throw all that into the mix, we think our capital intensity is going to be about half once those PCF deals are done. So now let's, last slide, talk about revenue. We have historically, over the last 3 years, talked about grow, nurture, and harvest when we talk about our product portfolio and a way to give some level of visibility into what's going on with revenues. This is a simplified view of that. It's really where we're going to start going, and it's quite simply saying what's strategic, what can we grow, and what's legacy? What's gravity? Because that's reality. And I think the important thing here is that if we were talking about grow, nurture, harvest, on our last earnings call, that grow bucket is almost half of what we sell today. Almost half of our revenues. When you look at it through this lens, which is pretty much the same thing, it's taking some of that nurture bucket, the pieces that can be delivered digitally, and moving that into the strategic. Over half of what our revenue is going to be next year is in that strategic bucket. So for the naysayers, yeah, the legacy's there. You can see it. It's the blue line, down and to the right. But don't forget the orange ones. It's not about us trying to inflect gravity. Those things are declining. They're great assets. They provide a lot of cash. They allow us to invest in our future. They are not our future. Our future is the strategic products, and that's what we've got a path to grow. So, super excited you're here today. Super excited that we can share our vision and innovation with you. Now let's get to the really fun stuff. All right, thanks.